Welcome to our deep dive into the reserve of KING-KAMBUF Financial News and Reports magazine. We've got the daily report for November 25, 2025, right in front of us.
And our mission today, as always, is to cut through the noise. This is a dense technical report, and our job is to pull out the truly actionable signals for you.
Exactly. We want you to be instantly well-informed, to understand what's moving the market, and more importantly, why.
And the context for this particular report is just fascinating. It captures this really critical moment for the market.
It really does. It's a period of, well, resilience, I guess you'd call it. But it's coming on the heels of what the report calls the most difficult November since 2008.
And just hearing that year, 2008, it immediately sets the stage, doesn't it? It frames the tension perfectly.
What kind of tension are we talking about here?
It's this pull between, a cautious optimism that we see in the numbers and this underlying volatility that's been hanging over everything. The market's basically fighting with itself.
Hope versus pessimism.
That's a good way to put it.
All right, so let's jump right into the headline numbers, because they really do tell that story of optimism, at least on the surface. We're looking at 3 consecutive days of gains.
And that 3-day streak is important. It's not just a one-day blip. It tells you that institutional money is likely starting to flow back in with some conviction.
Let's start with the Dow Jones Industrial Average. It had a huge day.
A monster day. It gained 664.18 points.
Which brought it to 47,112.45. That's a jump of 1.4%.
Yeah, a 1.4% move for the Dow is significant. These are the big established, old economy companies. It suggests the rally has some real breadth to it. It's not just tech.
Right. And speaking of breadth, let's look at the S&P 500. It acts as more of a barometer for the whole market.
It does, and it was up as well. It climbed 60.76 points, closing at 6,765.88.
So a gain of about 0.9%.
Yeah.
Still strong, but interestingly, less than the Dow.
That's a key detail, and it gets even more interesting when you look at the tech-heavy NASDAQ composite.
Okay, what did that do?
It also advanced up 153.59 points to 23,025.59. But look at the percentage.
Only 0.7%. So it was the laggard of the 3 major indices.
Exactly. The Dow, with less of that mega-cap tech influence, actually outperformed. It's a subtle clue that while tech was still positive, money was rotating.
Rotating into what?
Into some of those value and cyclical names, the industrials, the financials. It wasn't just another day of chasing the same handful of giant tech stocks.
So the big takeaway from the headlines isn't just that the market was up, it's how it was up.
Precisely. It was a healthier, more broad-based rally. It suggests a wider risk-on sentiment was taking hold.
But you mentioned that shadow of volatility is still there.
Oh, it's definitely still there. And that brings us right to the fear gauge.
Okay, let's decode that market sentiment then. We have to start with the VIX, the CBOE Volatility Index. What was the market's real mood?
The VIX tells a story of relief. I mean, the drop was just definitive.
How big of a drop are we talking?
It fell by 12.42% in a single day. Yeah, it settled at 20.52, which is way down from 23.43 the day before. A decline that steep just tells you that the market's expectations of a sudden, sharp correction were just, collapsing.
So portfolio managers were probably unwinding their hedges, feeling a lot more comfortable holding stocks overnight.
That's exactly what it signals. The immediate short-term anxiety just got priced out of the market. But, and this is a huge but.
There's always a but.
There is. We have to look at this in context. Even at 20.52, the VIX is not low.
What do you mean? It just dropped 12%.
Right, but compared to where it was a year ago, at just 15.24, it's still pretty elevated. It tells us that while the immediate panic is gone, there's still a lot of underlying concern.
So the market has moved from, say, red alert down to yellow alert.
That's a perfect analogy. It's gone from high alert to guarded relief. The anxiety is still simmering under the surface, and it's almost certainly tied to what the Federal Reserve is going to do next.
Okay, so that creates a bit of a contradiction, doesn't it? If the fear index is still somewhat high, why are the riskiest parts of the market suddenly acting so euphoric?
That is the exact disconnect we need to explore. And to do that, we have to look at the Russell 2000.
The small cap index.
Right. It's the real test of pure economic optimism. These are smaller, domestically focused companies, and they are extremely sensitive to the economy and to interest rates.
And what did the Russell do? I'm guessing it had a good day.
It didn't just have a good day. It blew the doors off. It gained 2.14%.
So it outperformed everything else by a wide margin.
A huge margin. A move that big suggests that investors are aggressively moving out on the risk curve. They're not just buying safe blue chips. They're piling into small caps.
What does that signal?
It signals a strong conviction in two things. First, that we're not heading for a hard recession, and second, that interest rates have peaked or are about to be cut, which makes borrowing money cheaper for these smaller companies.
So the Russell 2000s rally is basically a massive bet on a soft landing and future Fed rate cuts.
It is. It's a very aggressive, forward-looking bet, and it's based almost entirely on expectation, not on confirmed reality just yet.
And this is where the picture gets a little muddy, because while the stock market is partying, the report flags that consumer confidence is still pretty subdued.
And that's the central tension. The market is pricing in a perfect scenario, but the consumer, the person who actually drives the economy, is still cautious.
Especially heading into the holiday shopping season.
Exactly. If the consumer doesn't show up and spend, that optimism in the stock market could get a very harsh reality check very quickly.
And all of this, the VIX, the Russell's outperformance, the cautious consumer, it all points to one single event, doesn't it?
It all comes down to the Fed's December interest rate decision. That's the fulcrum on which everything is balanced right now.
The stakes are incredibly high.
They couldn't be higher. The market has placed its bet. Now we just have to wait and see if the Fed plays along.
All right, let's pivot to something that's maybe less about a single event and more about a deep structural issue in the market. We have to talk about concentration risk.
Yes. This is arguably the most important long-term theme for any investor to understand right now, especially if you're invested in index funds.
The numbers in this report are just stark.
They're more than stark. They're historically unprecedented. Your so-called diversified S&P 500 fund is not nearly as diversified as you think it is.
So let's get specific. We're talking about the Magnificent Seven: Apple, Microsoft, Amazon, NVIDIA, Meta, Google, and Tesla.
That's the group, and their influence is just immense.
So what percentage of the S&P 500's total value do these seven stocks represent?
According to this report, it's approximately 37.4%.
37.4. Let's just let that sink in. 7 companies.
It's incredible. It means that for every 10 points the S&P 500 moves, nearly 4 of those points are dictated by the performance of just these 7 stocks.
That is the definition of concentration risk. I mean, we haven't seen anything like this since maybe the Nifty 50 back in the 70s.
It's a very similar setup. A group of supposedly can't-miss stocks that everyone piles into, creating this bubble of concentration. And the reason it's happening now is because these companies basically own the infrastructure of the modern economy.
AI, cloud, consumer tech.
Exactly. They have these huge competitive moats. But it creates this massive systemic risk. If something were to happen to them as a group, say, a major regulatory crackdown, it would bring the entire market down with it.
Let's break down the top 4 just to see the scale.
Sure. Leading the pack is Apple, AAPL, which is 6.2% of the index all by itself.
6.2% for one company.
Right behind it is Microsoft, MSFT, at 5.8%. So just between those two, you're already over 12% of the entire S&P 500.
And then we have Google, or Alphabet, at 3.8% and Amazon at 2.9%.
Right. So if we connect this to the bigger picture, the risk here for you as an investor is critical to understand.
What's the bottom line?
The bottom line is your index fund is an illusion. You have to think of your S&P 500 holding as effectively a tech and growth fund that's dominated by these 7 names, not a broad exposure to 500 different companies.
And that reality is hammered home when we look at the actual sector breakdown in the report.
Absolutely. The dominance of information technology is just overwhelming. It's listed at 40.3%.
40%, and that number is probably low, isn't it?
It is, because it doesn't fully capture everything. A company like Amazon, with its massive cloud business, is technically classified under consumer discretionary. Tesla, too. So when you really add it all up, the market is profoundly dependent on technology and innovation.
So if tech makes up well over 40% of the market, what sectors are left to provide any real diversification? Where's the balance?
You have to look at the next 2 biggest sectors. Healthcare comes in at 13.2%, and financials are at 12.0%.
And they act as a counterweight.
They're essential counterweights. Their business drivers are completely different from tech. Healthcare is driven by demographics and drug pipelines, which is a long-term, non-cyclical trend.
And financials.
Financials are all about the interest rate cycle. So, in theory, if the tech sector corrects because, say, the AI hype cools off, healthcare should hold up because people still need medicine.
And financials would react to whatever the Fed is doing.
Exactly. They offer a genuine, non-correlated return stream that can help stabilize a portfolio when that huge tech concentration inevitably hits a rough patch.
That's a really important concept to grasp. Okay, let's shift from the big picture structure to the individual market movers, the extremes.
Right, the stock's hitting new highs and new lows. This is where we see conviction and opportunity in real time.
We'll start with the 52-week highs. These are the names where the market is placing its biggest bets, the ones consolidating their leadership.
A stock at a 52-week high is usually a sign of very strong fundamentals and powerful institutional buying. The trend is your friend, as they say.
And the list of names here is, well, it's not very surprising, is it?
No, it's the quality you'd expect. We see Apple, AAPL, trading at $276.97, just a whisker away from its high of $280.38.
That's with a market cap of $4.1 trillion. The strength is just incredible.
It is. It validates the idea that consumers are still spending and that Apple's services business is a fortress.
And then there's a name from outside pure tech that's just as impressive, Eli Lilly, LLY.
Ah, yes, LLY is a fantastic story, trading at over $1,100 a share, right at its all-time high, and knocking on the door of a $1 trillion market cap.
What's driving that?
It's pure innovation, breakthrough drugs in the obesity and diabetes space that have blockbuster potential. It shows that the market is willing to pay an enormous premium for innovation, even if it's not in the tech sector.
We also see the core AI infrastructure names on this list, Google or Alphabet near its high, and Broadcom, the chip company.
Right. GOG at $323, near $328. And Broadcom, AVGO, at $385, just shy of $388.
So what's the theme connecting these four? Apple, Lilly, Google, Broadcom.
The theme is leadership in foundational industries: consumer tech, pharma, search, and semiconductors. The market is rewarding the companies that own the essential infrastructure of our economy.
Okay, so now let's flip the script completely. Let's go to the other end of the spectrum, the 52-week lows. For a certain type of investor, this is where you hunt for bargains.
This is the contrarian's playground, but it requires a lot more homework because the stock is usually at a low for a very good reason.
So what are some of the potential value plays the report highlights?
Well, there's a big industrial name, Lind, or L-I-N, that's showing a bit of a recovery off its low around 406 TARP.
But the more interesting ones have these specific technical labels attached to them.
They do. For example, Texas Pacific Land, TPL, is identified as oversold near its low of $838.
What does oversold imply to a trader?
It's a technical term that suggests the selling pressure has been excessive and is likely exhausted. It means a short-term bounce or rebound is statistically probable.
And what about the others?
We have TELUS, TU, which is a telecom company. It's labeled as bottoming near its low of $12.87. That usually means the stock has stopped falling and is entering a consolidation phase, which could be the precursor to a recovery.
And then there's one with a very aggressive label, Venture Global, VG.
Yes, that one is identified as depressed near its low of $6.72.
Depressed sounds pretty bad.
It sounds bad, but for a value investor, it can be a very strong signal. It implies that the analysts believe the stock's current price is far, far below its actual intrinsic value. It suggests there could be substantial upside if and when sentiment finally turns.
So these are potential diamonds in the rough, but they come with significant risk.
Absolutely. High risk, potentially high reward.
Okay, now for the daily fireworks, the biggest gainers and losers of the day.
This is where the tactical high-speed trading happens, and you have to be extremely careful here.
The gains on this list are just astronomical, mostly in the small cap and micro cap space.
They are. Take Antelope Enterprise Holdings, ticker AEHL. It gained, get this, 109% in one day.
109%. That's incredible.
We also saw Splash Beverage Group, SBEV, jump almost 53%. And Ondas Holdings, ONDS, was up nearly 30% on very high volume.
When you see moves like that, what's usually behind them? It can't be fundamentals changing that quickly.
Almost never. It's usually a low-float stock, meaning there aren't many shares available to trade. Combined with a short squeeze or some sudden news catalyst, it's momentum chasing momentum.
So the caution here is that these moves can reverse just as quickly as they happen.
That's the critical point you have to remember. These are not buy and hold investments. I mean, we all remember the meme stock craze. A lot of those stocks that went up hundreds of percent are now gone. You have to treat these as tactical trades with very strict risk management.
All right, let's look at the other side, the losers. This tells us where the money is flowing out of.
And it gives us some good clues about market sentiment. The biggest loser was Carnival Corporation, CCL, down almost 6%.
And the report gives a specific reason. Travel softness.
Right. And that connects directly back to what we said about subdued consumer confidence. Travel is discretionary. If people are worried about their finances, that's one of the first things they cut back on.
We also saw Robinhood aid down over 5%, attributed to sector rotation.
That suggests money is moving out of some of the high-flying fintech names and maybe into more traditional banks or other financial infrastructure plays.
And even a giant like Amazon, AMZN, was down about 1.65%.
And its loss is labeled consolidation. That's just normal profit-taking after a big run. It shows that even within the biggest and best names, capital is constantly moving, looking for the next opportunity.
This all flows perfectly into the next section, which is probably the most technical part of the report. It's about actionable trading signals.
Yes, this is where we get into the proprietary TKE20 plus trading analysis. We're shifting from broad analysis to very specific trade ideas.
Okay, can you break down what TKIFWAS actually is? It sounds complex.
It is, but the concept is straightforward. It's a strategy designed for swing trading large liquid stocks. The KIFE part stands for Kalman filtering, integrated with exponential moving averages.
In simple terms.
It's a sophisticated way to identify a trend's strength while reducing the lag you get from simple moving averages. The 20-plus part means it's optimized to find stocks that have a predictable $20 to $30 trading range or spread opportunity over about a 20-day period.
So it's looking for high-probability swing trades in blue-chip stocks.
Precisely. It's all about finding repeatable patterns in stocks that big institutions are trading heavily.
So let's get into the best 5 stocks with optimal spread that this system identified. And it's no surprise, they are all tech leaders.
Of course, that's where the liquidity and the trends are. First up is Microsoft, MSFT. The system identifies an entry range of $545 to $555, with a price target of $565 to $575.
And it's labeled with a favorable risk-reward profile.
Right. Favorable means the underlying data, like volume and institutional ownership, suggest a high probability of the trade working out and a lower chance of getting stopped out.
Next on the list is NVIDIA, NVDA. Entry is $125 to $135, with a target of $145 to $155.
But notice the difference here. NVIDIA is labeled with a moderate risk-reward profile.
Why is that? The potential gain is the same.
It's because NVIDIA is a much higher beta stock. It's more volatile. If the overall market has a bad day, NVIDIA is likely to fall much harder than Microsoft. So while the technical setup is good, you need to be much more vigilant with your stop loss.
That makes sense. We also have 2 more favorable plays, Apple and Google.
Yes, AAPL with an entry of $270 to $280 and a target of $290 to $300, and GOG with an entry of $335 to $345.
It reinforces that idea that these foundational tech giants offer the best risk-adjusted trading opportunities.
They do. Their massive trading volume provides a lot of stability and makes the technical levels more reliable. The list is rounded out by AMD, another moderate risk pick, with an entry of $100 to $120 and a target of $130 to $140.
The entire section is basically a giant confirmation that for short-term profits, the path of least resistance is in semiconductors and AI infrastructure.
That's where the momentum is, without a doubt.
Here's where it gets really interesting. Let's move from those broader swing trade ideas to the immediate high-conviction buy signals.
Right. These are the top 10 buy entry recommendations. These are more aggressive calls, often targeting double-digit percentage gains in a shorter time frame.
Let's look at some examples. NVIDIA is back on this list.
It is a specific buy entry at $128 with a target of $142. That's a targeted upside of 10.9%. A very aggressive bet that the AI narrative continues to run hot.
They're also targeting some of the next-tier growth names. Palantir, PLTR, is on here.
Yes, with a buy entry at $29.50 and a target of $32.50. That's a potential 10.2% upside.
And as we go further down the list into the more speculative, emerging tech areas, the targets get even bigger.
They are much more aggressive. Look at D-Wave Quantum, QBTS. The system flags a buy entry at $32 with a target of $38. That's a potential upside of 18.8%.
18.8%, that's a huge move.
It is. And another one is NoScale Power, SMR, a company in the small modular nuclear reactor space. Buy at $40, target $47. That's a 17.5% upside.
So these are high conviction calls on what could be truly world-changing technologies.
Absolutely. Quantum computing, new forms of nuclear power. But they come with commensurate risk.
And for the really short-term traders, the report even provides specific day trade projections.
It does. For momentum candidates like PLTR, NVDA, and APLD, projecting moves of anywhere from 6 to almost 17%.
But the report stresses discipline, right? You can't just chase these numbers.
Discipline is everything. The report is very clear. The bullish signal requires a stock to cross above its 50-day moving average on high volume. And most importantly for you, the risk management is non-negotiable.
What's the rule?
A standard stop loss of 2 to 3% below your entry price. You absolutely cannot aim for an 18% gain if you're not willing to cut your loss immediately at 2 or 3%. That's how you survive.
To put all of this technical optimism in perspective, we should touch on the earnings backdrop. This isn't just happening in a vacuum.
That's a great point. The fundamentals are actually very, very strong. For the third quarter of 2025, S&P 500 companies reported average year-over-year earnings growth of 12%.
12% is a very healthy number.
It is. But what's really remarkable is that this was the 9th consecutive quarter of double-digit earnings growth.
9th in a row.
That sustained level of corporate profitability provides a really powerful foundation under the market. It helps to justify some of these high valuations and gives investors confidence.
And we also saw strong reports from the financial sector recently. JP Morgan, Citigroup, Wells Fargo.
That's key. A healthy banking sector is crucial for a healthy economy. Their strong earnings really bolster that whole soft landing narrative we were talking about.
And in tech, the report mentioned Autodesk, ADSK.
Yes, they topped expectations, citing strength in their design software, and they gave cautiously optimistic guidance. It's just another piece of real-world evidence that supports the market's overall bullish posture on technology.
Okay, let's pull back from the day-to-day and look at the long-term investment strategy. The report lays out 3 distinct portfolio recommendations.
And it's really important for you to remember that these are just blueprints. You need to align them with your own personal goals, your own time frame, and crucially, your own tolerance for risk.
Let's start with the most foundational one, the conservative portfolio.
This one is all about capital preservation. It's targeting a modest 6 to 8% return. It's built for stability.
What's the allocation look like?
It's 60% in blue chip tech, 30% in healthcare, and 10% in defensive staples. And the top picks are the names you'd expect: Apple, Microsoft, and Johnson & Johnson. Rock-solid companies designed to weather any storm.
Okay, moving up the risk ladder, we have the moderate growth portfolio. This is probably where a lot of our listeners see themselves.
I would think so. This one targets a more ambitious 12 to 15% return, which is aiming to be in line with or slightly better than the long-term market average.
And the allocation here is more balanced.
It is. It's 45% large-cap tech, 25% healthcare, 20% financials, and then it introduces a 10% slice for emerging growth. The picks include AI leaders like NVIDIA and Google, balanced with Eli Lilly from pharma, and then some of those faster-growing names like Palantir and AMD.
So you're taking on a bit more risk to capture more upside.
Exactly. It's a balanced approach to growth.
And finally, we have the aggressive growth portfolio, the high-octane option.
This is for investors aiming for 25% or more in returns. And you have to be honest with yourself. This requires a very high tolerance for risk and the ability to stomach some potentially significant drawdowns.
What does an aggressive allocation look like?
It's a deep, concentrated bet on the future. 50% in growth tech, 30% in emerging fields like quantum and AI, and 20% in what it calls speculative momentum.
And the top picks here are very different.
Very different. We're talking about QBTS for quantum, Rocket Lab RKLB for the space economy, NuScale SMR for nuclear, APLD for data center infrastructure, and IONQ, another quantum computing play. These are companies that could change the world, but they could also fail.
So you have to be willing to accept that binary outcome.
You do. If you want that kind of alpha, you have to invest in companies that are not yet proven winners.
Okay, let's bring the focus back to the near term. The biggest catalyst on the horizon is the Federal Reserve's December decision on the 17th and 18th.
The entire market is holding its breath for this, and the report does a good job of quantifying what the market is actually expecting.
What are the probabilities?
Right now, the market is pricing in a 65 to 70% chance of a 25 basis point rate cut.
So a cut is the base case scenario.
It is, by a wide margin. The probability of the Fed holding rates steady is only about 25 to 30%, and a hike is basically off the table.
What does that mean for how the market will react?
It means a rate cut is already largely baked into stock prices. So if we get the cut, the reaction might actually be pretty muted. Maybe the rally continues, but it doesn't explode higher.
But what if we don't get it? What if that 30% probability happens and they hold?
Then you can expect a very swift, very negative reaction. The market would see it as a major disappointment, and you could see a lot of the recent gains get wiped out very quickly.
What other catalysts should we be watching through the end of the year?
The jobs report on December 6th is huge. If it's too strong, you might make the Fed nervous about cutting rates. If it's weak, it reinforces the case for a cut.
And then there's the holiday trading environment itself.
Yes, this is so important for traders to remember. During the Thanksgiving and Christmas holidays, trading volume gets extremely thin.
What does that mean in practical terms?
It means the market is more fragile. A single large buy or sell order can move prices much more than it normally would. You get what's called whipsaw, risk sharp, sudden moves in both directions. You have to be very careful.
And finally, year-end rebalancing.
Right. Portfolio managers will be selling their losers to lock in tax losses and maybe trimming some of their winners. This can cause some turbulent but often predictable rotations in the last couple weeks of the year.
So to wrap up the outlook, what are the big sector themes the report expects to lead through the end of the year?
It's a continuation of what's been working. Continued leadership from artificial intelligence is number one. Ongoing strength in healthcare innovation with a big focus on companies like Eli Lilly. And then it sees positioning in renewable energy and a continued recovery in financial services.
So we've covered a ton of ground here, from market sentiment and concentration risk to specific trade ideas and the macro outlook. Let's try to distill it all down. So what does this all mean?
It means we're in a very complex environment. You have this backdrop of macro uncertainty with the Fed, but you have overwhelming strength in corporate earnings at the micro level. That ninth straight quarter of 12% growth is just a massive tailwind.
So the environment is actually pretty favorable for investors.
It's favorable for disciplined investors. The report really emphasizes the need for precision.
The strategy seems to be about balancing the momentum in big tech with finding value in some of these other oversold sectors.
That's it exactly. It's a market that rewards surgical precision, not broad passive bets. Being able to execute your plan, using those tight stop losses we talked about, is going to be what separates the winners from the losers.
Which brings us back full circle, really, to the final big question for you to think about. And it goes back to that systemic risk we started with.
The concentration problem.
Exactly. Given that tech is over 40% of the market, and the Magnificent Seven have this incredible gravitational pull on the entire index.
The fundamental question every single investor has to ask themselves is this: how do you properly mitigate that risk in your own portfolio?
Is it enough to just rotate some money into those counterweights like healthcare and financials? Does that provide enough stability if those top 7 stocks all decide to correct at the same time?
Or does true risk management in this environment require something more? Maybe using options for hedging, or even taking non-correlated positions outside of the stock market altogether.
That strategic challenge, how to diversify away from the market's biggest winners, is probably the defining question for investors for the next several years.
It is. So ponder that as you look at your own allocations heading into this huge Fed decision.
Thank you for joining us for this deep dive into the reserve of KING-KAMBUF Financial News and Reports magazine.
Until the next report, trade smart and keep a very close eye on those big 7 stocks.